So today we've got a lot of stocks to talk about. We've got some HIMS news. I actually then also sold a stock, well, I trimmed the position for a 200% return yesterday. Some DraftKings news, some luxury stocks news, some UK stocks news. There's a lot of stocks today. It could be a long one, so we'll see how we do. As always, if you could hit the like button, if you're new around here, subscribe. As always, let's get started on today's video. Now, if you are a Patreon member, I have just posted on the stock request. We are going to do an exclusive content this week on a stock that you guys on the Discord want me to do. So if you join the Patreon, you get the Discord for free, which is £5 a month. And on there at the moment, the votes are starting to come in for stocks that I could potentially do the stock request on this weekend. So if you do want that exclusive content, join the link in the description, £5 a month. First of all, HIMS and Hers. So HIMS and Hers, cracking day yesterday. Stock was up 10%. It was up a little bit more, came back a little bit from its highs. It opened up at nearly at $20. And yeah, big jump from HIMS and Hers. We covered it on Saturday. There was some other extra news out there though that we'll touch on, but obviously we covered it on Saturday. The news that Burberry, they're wasting their ads on me. Look at that. They were included into the S&P Cap 600. Obviously, I'm not going to talk about it too much because I spent so much time on it on Saturday talking about it. But great news for HIMS and Hers, and we saw the pop up in share price. On Saturday, though, I think the stock closed on Friday up like 5%, but it was up even more today. So great to see that the shares are rallying off that, and I think that they'll pause that. I think that the stock will rally probably up to Wednesday until it actually is included into the S&P 600. The other news for HIMS and Hers is that Novo Nordisk, which is one of the producers of the GLP-1, the suggestion is that from Jefferies that they are still struggling for supplies, and as we know, HIMS and Hers provide a copycat of this one, not the Eli Lilly as somehow the stock market and analysts made the big mistakes of. And we saw the volatility in the HIMS and Hers share price with that when the stock decided to drop a ton, and then it even dropped a little bit last week, and now it's decided to recover it all. And yeah, the suggestion is that there is still big supply chain bottlenecks, and Jefferies actually said that they have downgraded the stock. And probably the rally on HIMS and Hers yesterday was to do with the S&P 600 inclusion, and probably the fact that they are going to get more access to this GLP-1 that people thought might be over because Eli Lilly ended their shortage. So yeah, I mean, the stock is very volatile at the moment, and I'll be actually quite happy when this GLP-1 business is kind of gone away from the business, to be honest with you. In the short term though, it's providing opportunities. It's bouncing around everywhere, opportunities to, for the stock to go up, to go down. Obviously, I bought for the first time in September. First time I bought since the stock was $6. I hope Andy Pickering bought some shares as well. And from that time, the stock has rallied up around about 39%. I did yesterday, actually, from the money that I put in on the 13th of December, I sold exactly the same yesterday. So I did take a bit of a trim position in HIMS and Hers around about 2%. That was for a 200% return, which is unbelievable, absolutely amazing. It's been a cracking year in the stock market, and HIMS and Hers, it's been a cracking stock for me. And once again, just nice to take some profit off the table. Obviously, I still believe in HIMS and Hers for long term. That's why I'm keeping so much of my position there. But I just thought, you know what? I've made an easy within month, like big jump here. I've put a bit of money in, I took that money back out, and actually with the profit that I have, I've actually increased my position size. So yeah, I'm a winner all around really. And at the end of the day, as I always say, I'm here to make money. You guys are here to make money, and if I'm making some money, I'm going to take it, and then we'll go from there. I have the option now that if HIMS and Hers falls again because some fear comes around the GLP-1, which it can do, we've seen it already, multiple times this year. If the fear comes back around and it forces the stock to go down, 30, 40%, then I'll have the opportunity to once again buy back at good ranges. And if it doesn't go down, hey, I've still got a big chunk of my position in the stock to make a lot of money from it anyway. But a nice little bit of profit there. DraftKings, a bit of a weird day from DraftKings yesterday. The market in general was okay, but for DraftKings it were down like nearly 4%, and I have no idea why it went down. In fact, I thought DraftKings would be up yesterday. Analysts came out and they raised the stock price target. They increased it from $48 up to $50, remaining positive on the stock. I mean, $50 is nice, plenty upside from where the share price is right now. And you got to remember, a lot of these analysts, do targets for the next 12 months. So they think that DraftKings can get to $50 in the next 12 months, which I don't actually disagree with too much. I think like DraftKings right now, I think DraftKings should probably be in the $40 range for sure. So I would expect it to close around $45 ish by the end of the year, in my opinion. But we'll see what happens. Like I don't think the stock should be up only 12% this year. I think the stock should be somewhere between 30% up this year, considering the numbers that it has done. But yeah, they turned even more bullish on it because they said the Q3 outcomes have been very good and they should do a very strong Q3. I 100% agree. I've looked at the outcomes. I think DraftKings is set for a very, very strong Q3. So hopefully when we do have the Q3 results come out, that does lift the stock up. So we'll keep an eye on that one. Celsius had a bit of a weak day once again yesterday. The stock was down 4.7% and it's just in free fall now, down 51% year to date. And you know, you just think a stock can't go any lower and it just continues. It's as you say, it is an official falling knife at the moment. But I was looking at Celsius and I was thinking, you know, this company's now 28 times earnings. And I was thinking, I've got some concerns around the UK side of Celsius. Like, I don't think the UK side is going that well at the moment, and I think it could be done better. I think the marketing's poor. I think the products are the ones that the flavours have chosen are pretty poor. I think it could be done a lot better. But I have the concern because, you know, I think the UK could be a big market for them. But at the moment, obviously, you know, the UK market isn't contributing much to the numbers. Like on the recent quarter when Celsius went up 23% and the net income went up 54%, these are fantastic numbers, but the UK isn't really contributing that much to those numbers. So even if the market fails, we're not losing anything because we haven't gained anything. All this kind of growth is coming from like the US and the Canada expansion. And I was looking at Celsius and thinking, you know, even if the UK market fails and it just continues in like Canada and the US, is 28 times earnings too cheap for this stock right now? Because I think that US and Canada market has so much potential still. You know, it's only just scratching the surface. And that market has the potential for Celsius to be able to grow, you know, 10% a year on just like the US and, you know, the Canadian market. So with that potential that it can just grow that much on that market, at 28 times earnings, is this not now, you know, a pretty attractive valuation? I was thinking, you know, it potentially is. You know, you look at the share price now and it's, you know, heading back to the levels that it was at back in, you know, getting towards like 2022 levels. In fact, it's actually getting towards levels when I started buying the first time round. Not as much, it's still up a little bit from that time frame, but it shows you how much it's kind of come back a little bit at the moment. And I think as soon as that Pepsi inventory issue has kind of gone, I think we might think, you know, probably should have bought a few more shares there. So yeah, a little bit interesting there because I was a little bit hesitant to buy more shares in Celsius because I felt like you needed the worldwide expansion to be successful for this to work out. But I'm looking at the moment and I'm thinking, actually, you know what? It's even if that worldwide expansion fails, it's not a bad valuation here. I'll tell you what's not going well. The UK markets, there is some weakness out there in the UK markets. And at the moment, I think it is caused by the potential of the upcoming budget in 2024. Obviously, we have the new government and they are going to do their first budget as the current government. I am concerned around the current government. I think they have done a very poor job in the first few weeks in office. And listening to what they're going to do, obviously, as most governments do, they have gone against a lot of what they said they were going to do. And at the moment, I don't think they are potentially looking at the right things that would have a strong economy for the UK side of it. And it's a little bit concerning. Even though the Conservatives were an awful government before these guys, at least we know the economy would be okay-ish. With these guys in charge, it is concerning around the UK stocks and the UK economy, where I actually do consider, like, you know, how much exposure do I want in this kind of space, and maybe that's why the UK stocks have been a little bit weak at the moment, because, you know, UK investors are kind of getting a bit nervous about, you know, where are they going in the budget? You know, what is going to be taxed? What is going to be hit in this new budget? You know, if Labour are going to go ahead with the plans that they have and are handing pay rises out like candy at the moment on Halloween, you know, I don't know why I say candy instead of sweets, but if they continue handing out sweets like someone does on Halloween with pay rises, they've got to raise the tax from somewhere, and I think everyone's concerned about where that is coming from. But it's just leading to things like Gaming Realms. Looking at Gaming Realms the other day, and, you know, the stock is flat this year, 2% up. But the company is at 16 times earnings, and the company has just grown 17% year over year and 31% net income growth. And I'm like, well, how is Gaming Realms at this sort of valuation with these numbers? Like, You're not even talking about a company that should be like 20 times earnings. It should be a company it's a growth company. Growth companies historically trade at what, 30 times earnings, 35 times earnings, and it's even below a market average valuation. Like, it just doesn't make sense why this one is so low, and it has been so low for so long. That's when it gets frustrating. That's when it gets frustrating as an investor, when you own a stock and you're like, why is it not going up? Because it should. This should not happen where you have a stock growing like 31% net income and your stock is up 2% year to date. That's where it gets kind of a little bit frustrating as an investor, because next thing you know, there's a bad update out, and then your stock goes down like 30%. You're like, hold on, we've got one bad update and you crash that much, and we've had all these good updates and you don't move. I mean, Hollywood Bowl, last 6 months down, Hollywood Bowl's down 8%, 15 times earnings, 13 times earnings on a forward PE. And these guys, the last financials, I think I've just accidentally, oh no, there they are, 8% revenue growth, net income up 5%, and yet the stock is down in the last 8 months. I mean, year to date, what's it up? 1%. It's just crazy, some of these UK stocks. Money Supermarket, year to date down 22%, 14 times earnings, 5.77% dividend yield, coming off revenue growth of 4% and net income growth of 8%, and the stock is down 22% year to date. That's crazy. Card Factory, I know we got a little bit concerned around like the last kind of update, and can they hit the full year figures? But even if they're only like close, even if they miss but they come close to the full year figures, this stock is still going to look incredibly cheap. Like, the stock is down 9% year to date. It's at 7 times earnings with a 6% dividend yield. It's just, yeah, that's just crazy, isn't it? JD Sports, I mean, we've seen a good Q1 trading update. We saw a good H1 update, and this was doing all right. And now year to date, the stock is down 18%. Year to date, down 18%. From the end of September to where we're at now, within like 2 weeks, the stock's fallen 15%. And yet the company has, they've got the fake net income here because of the one-time charge there. But if you actually look on an adjusted basis, the revenue growth was it like 8% or something? And on an adjusted basis, the growth was higher as well. Yeah, that's crazy. And Warpaint has been down 16% since July time, and in that time they brought out the H1 results where the revenue was up 24%, the net income was up 67%. 67%. Year to date, it's still not too bad, I guess. You could argue the case, yeah, it's up 35%, but that's still way below the net income growth of 67%, and it's down at 16 times earnings. So yeah, there's a lot of weakness in the UK stocks at the moment, and I just don't know if that's the concerns around the budget there, and maybe we'll have to wait until the budget, and if everyone goes, actually that's a lot worse than what we expected, then the stocks tank even worse. Or we actually go, actually it wasn't that bad, and maybe the buyers think, actually, we'll come put the money back in anyway. So we'll see what happens there. European markets, and also the China stimulus. Obviously, China stimulus has been strong for a lot of stocks last week. Seems to be fading a little bit today, but luxury stocks slump big time today. If we look at Kering, down 5% at the moment. LVMH is down 4% at the moment. Burberry is down 5% at the moment. So a lot of those gains that they just had in the back end of September, a lot of it has started to be given back a little bit at the moment, which is probably those kind of unnatural jumps that they did have. But I think a few people kind of realise this China stimulus doesn't actually mean they're going to show any benefit in the short term of revenue and profit. So actually maybe we've gone up a little bit too much, and I think that's what happened. But I've got to say, I do stare at some of these stocks like Kering and LVMH and Burberry, and I think one of them at least is going to do very well going forward, probably more than one of them. And I think one of these has to be a good option there. One of those that you look at. Do you remember when all luxury stocks crashed in 2024, and you could buy Burberry at £6.40, or you could go buy Kering at I don't know how the euro is. Is it €2.35 or is it €235? I don't know how you pronounce the euros actually side of it. But will you look at that time frame where actually I probably should have been buying some of these luxury stocks? The other thing is that always makes me nervous, and why I'm not pulling the trigger on them, is that I look at Kering and I just don't know where Gucci will be in 2 years' time. Is that going to be a popular brand again? I look at Burberry in 2 years' time. Is that going to get to a popular brand again? I look at the numbers though, and I think if they get anywhere close to where they were previously in 2019, some of these valuations are very attractive, and I think, is it worth taking a purchase on one of them, whether that be Burberry or Kering? And I think, one of them has to be an opportunity here. And I don't actually own anything in the luxury sector with this big slump going on at the moment. I guess you could argue the case that I have watched the Switzerland Group, which obviously has big exposure to Rolex prices potentially, so I guess there is some exposure there. But apart from that, I don't really have a pure kind of big luxury player in this space. I gotta say, like, Burberry's the one that is starting to tempt me a little bit at the moment, because I mean the stock is it's back down at prices it was at in 2007 basically. And just to show you on like simply Wall Street, for example, the potential of Burberry. If you have a look at the potential past performance, for example, and let's say let's go on past performance, and let's just go back to, I don't know, 2017, 2016. If they get to like a 285 million in profitability, or 300 million in profitability like they did in 2017, 2018, on a 2.4 billion market cap, that's, that the stock will 2x from here. It's one of those. I mean, the only thing with Burberry is the financial health wise of the business. They have loaded up on a bit of debt, but it's still not terrible, is it really? So I don't know. I've got to have a good think about this space, because I think one of them I have to take, even if it's like a smaller position. I feel like I've got to take a small position in one of them. I just don't know which one. So yeah, I just keep thinking on that anyway. That's the video for today, guys. A lot of stocks, HIMS, DraftKings, UK stocks looking cheap, luxury stocks looking cheap. There's definitely still opportunities out there anyway. So yeah, that's the video for today, guys. Hope you enjoyed it. Let me know what stocks you're looking at, and we'll see you in a bit.